Risky municipal bonds are on a hot streak. Investors seeking yield are piling into the riskiest corner of the municipal bond market at a pace not seen in decades. They have poured $8 billion into funds that deal in high-yield muni bonds urgent municipes year, at most through May since at least 1992, according to Refinitiv data. Muni bond funds, there is more demand than at any time in recent memory, said Jeff Berger, a portfolio manager at Mellon Investments Corp., which oversees $25 billion in municipal investments. Investors have jumped into the municipal bond market in search of returns this year as Treasury yields have fallen and analysts' expectations that the Federal Reserve might cut interest rates this year have risen. Recent changes now, the strong appetite for munis has extended to sometimes riskier borrowers in the historically safe market for state and local governments. That has translated. Bob Powell, chief of Brightmark Energy, recently oversaw an unrated $185 million bond deal to build a facility in Ashley, Industry, that would convert plastic to fuel-on wax for the residential Polyflow Indiana project. Investor reaction was astounding to me, said Mr. Powell, adding that there were more orders for bonds than the company was selling. It was at a level where the company sold the debt at interest rates close to 7%, far above what munis typically fetch, but on the low end of what Mr. Powell said he initially expected. The strong demand for muni debt has pushed down the yield on the Bloomberg Barclays Municipal Bond High Yield Index to around 4.54% late last week, near a 16-year low, FactSet data show. The yield on the Bloom-related video the case for active management in bond portfolios. A recent stretch of turbulence in the stock market has also helped drive interest, analysts said, pushing investors toward munis because of their stable returns and low default rates. Although muni defaults have become more common recently, the municipal default rate has been about 0.1% since 1970, according to Moody's Corp.'s analysis of its ratings. That is well under this. The non-investment grade or unrated munis can be riskier, however. About 2. High-yield munis outperformed corporate bonds, stocks and treasuries last year and have returned to 5% this year, counting price changes and interest payments. FactSet data show high-yield corporates have returned 8%. Virgin Trains USA, backed by Fortress Investment Group, has benefited from high demand for munis. Also known as Bright, but it didn't fill up its trains with as many passengers as expected in 2018 after station opening delays, according to bond offering and financial documents. The company also, even so, in April, muni investors lent Virgin about $1.8 billion to expand, marking the largest unrated muni bond deal over the past 5 years, according to calculations BMA. Brian Wynn, head of public finance at Morgan Stanley, which underwrote the bonds, said high demand enabled the railway to sell $250 million more in debt than initially planned, with yields roughly a fifth of a percentage point less than expected. Virgin could issue such bonds enable the private sector to deliver critical infrastructure projects, said Wes Edens, co-chief executive of Fortress and chairman of Virgin Trains. All the stars have aligned for these types of loans, said Rob Amodio, head of municipals at Western Asset Management Co., which oversees about $22 billion in munis. He bought high yield, but he warns the streak can't last. It's not sustainable. As investors keep piling into the sector and the rally continues, muni bond yields keep falling and could grow less attractive relative to treasuries, investors said. Additionally, Nicolas Venditti, a portfolio manager at Thornburg Investment Management, said he is avoiding high-yield munis. Anytime in any write to Gunjan Banerjee at wsj.com.
Raindrop, truck top, smoking, no cooking the hot pot. Fucking on your bitch, yeah, that. Looking up, open the park,